Welcome to another edition of Dream Firm Spotlight. My name is Tyler S. Clark, co-founder of Dream Firms, where we create generational wealth and impact for entrepreneurial accountants by systemizing how they attract, win, and retain the business of your dream clients. And to help you to do just that, we're actually going to do something a little bit different today. Yes, we normally talk about dream client acquisition systems and winning back your time and all of the different ways to do that, but there's another strategy that is pretty popular, but typically only accessible by a select few in the entrepreneurial accounting space, and that is how to buy an accounting firm. It is certainly a growth strategy, one that can be leveraged in a meaningful way, and I'm here to make sure that you do it the right way. So again, we're here to discuss how to buy an accounting firm, and I've got 11 tips, secrets, strategies, whatever you want to call them, that I know that will benefit you on your journey to securing an acquisition on your terms. We're not going to be talking about this necessarily from the seller perspective, but we'll have a video coming out in the not so distant future that addresses that, specifically preparing your firm for an acquisition. But for right now, we're going to stay focused on the buyer side, but these things should be mutually aligned, right? That's the whole idea. So let's go ahead and jump off. So the very first thing that I want to make clear is the state of the union of the current accounting acquisition landscape. What's fascinating is that if you're plugged into the space at all, you'll notice that a lot of firms are being listed. Historic number of firms are being listed. And so that's very interesting from the buyer perspective. Because you have to say, why is that, right? What's causing that? And again, I'm not feeling so well today, so sniffles and all that, but why is that? And if you reflect on what's transpired over the last couple of years, massive legislation, tons of work, less people coming into the profession, and more people exiting the profession. So what has historically been known as a seller's market? In other words, the sellers, you have that asset, you've got that client base, you've got that predictable recurring revenue, you have those relationships, you worked hard to build up those, build up your business and your revenues. And now you are able to dictate terms pretty aggressively to those buyers. But what I'm starting to see is this is not so much a seller's market. It still is, because most entrepreneurial accountants are still very averse to the idea of sales and marketing. They'd rather go buy a book of business. And I get that, right? It's a tough skill to learn. We make it very easy. But the point is, people are still very averse to it. And so there are still a lot more buyers than there are sellers. But there are way more sellers than there have historically been. So just understand that that shifts the landscape just a little bit in favor of you, the potential buyer of a firm. Second, know the space and know the players in it. When you're getting ready to move into what I will refer to as a high risk acquisition, because it's a lot of money, right? A lot of money equals higher risk. And there are ways to do it the right way. There are ways to do it the incorrect way. We're going to make sure you know how to do it the right way. But in order to limit your risk, you got to know the landscape of who are the movers and shakers in this particular category. Now, I'm going to share with you two or really a couple of names in this particular blurb right here. But the first one that I want to share, and you can call this nepotism if you'd like, whatever, but it's my father. My father runs New Clients Incorporated, and he has helped many people to connect buyer and seller. So if you are looking for a great broker, please understand that New Clients Incorporated and Bruce Clark would love to help you. But I'm going to actually do something a little bit different here. I got an email when I promoted this particular training from a former client, and I'm going to read that email back to you. I'm going to, of course, not say who it is, but we get emails all the time from former and active clients that just give us updates on the space. And this was a very, very interesting one. So bear with me as I read this to you. Hi, Tyler. It's been a few years since we spoke. That was back before your current business ventures. Hope you are doing well. I'm actually closing a firm on Friday. There are a ton of accounting firms for sale right now. I wanted to give you a suggestion of a great broker and bank if anyone contacts you for more information. So I just want to give it to you now because, why would I hold that back, right? So the broker is Chuck Hayes with ABA Advisors. He's one of the oldest brokers specifically doing accounting practices in the country. I can tell you he doesn't use a lot of the pressure tactics other firm brokers use, and helps with favorable terms on both sides versus some of the brokers that tell sellers they'll get an all-cash offer with no guarantees. Then the SBA lender I used after getting turned down by 2 banks that seem to do a lot of accounting firms is Bay First out of Florida. They have a high approval rate and close 94% of their deals. I found that two big banks for accounting firms didn't like my small $400K practice deal. I realized doing an SBA loan with these people is a game. Each underwriter has their quirks, and you have to edit what you say and do for legal disposition. You got to be friendly, you got to shoot the breeze, because they're paid to find reasons to not take a risk. This is also true, sidebar, for SBA. Just be advised that you got to be able to play the game a little bit here. So Live Oak turned me down in a few days. The other took 3 weeks to tell me they denied me after sounding like they were a great bank and wanted female-owned businesses to succeed. The first underwriter was fired or quit for some reason, and then a few days after, I was denied by the guy that replaced her. But Bay First has been a great bank and got it done in 6 weeks. None of the underwriters were hard to deal with, and the closing people were great. With COVID, SBA loans taking 6 to 8 months, but now they're back to 2 to 4 months. Chuck said that most firms can expect to get turned down by 4 to 5 banks, and that has to be factored in closing timelines, but each lender is different with how they see asset deals with seller guarantees. Another great contact is Baylor Pate. He's a loan broker that found Bay First for us. So if anyone has trouble finding a bank, they help, and they only charge a $1K finder's fee. I wish I would have used Baylor first to go straight to Bay First, because we would have closed in July versus September. Quick sidebar, that's going to become important later on when we talk about timeframes for acquisitions. Anyway, I thought I'd pass along this info. If you have anyone reaching out needing assistance, and the good news is that we do. And so thank you to the individual who shared this information with me. It corresponds with a lot of what I already knew, but it just gives you a little bit more of an understanding of someone who has gone through this process and what it takes to be able to go through it successfully. Know the players in the space. And I'll take it one step further. Call them, introduce yourself, let them know what you're looking for, what type of practice, the size, your liquidity, your financial statements. The brokers want to have high quality, not only sellers, yeah, that's the name of the game for them, but without high quality buyers, nobody wins. So if you are motivated and you have the capacity and the ability to play in this space, make sure the brokers know who you are and touch base with them every couple of months, right? Review their listings, get on their email list, know the space, okay? And I hope that gave you at least a couple of contacts that could be useful for you. Okay, so the third point, and I hope this one is obvious at this stage in the game, but leverage a broker, right? Like, leverage a broker. You want to use the expertise of the people who do this all the time. They know what to look for. They know what the norms are. They know how to have the legal agreements in place. They know what is a realistic request and what is a ridiculous request. They are going to provide a great experience. Is it going to have a pretty large investment price tag to have that broker? Yeah, of course. But there's a reason, right? More money, more risk, brokers involved. They got to make sure everyone's happy. So they need to be well compensated to ultimately facilitate that peaceful transition that ultimately makes both parties very, very happy. So again, point number 3, please use a broker. Don't try and wing this. Don't use some random lawyer. Just use a broker. They're literally trained and have tons of experience in the space. Fourth point, be realistic, okay? Like, be realistic. And when I say be realistic, when you are buying an accounting firm, I know it is really a really sexy webinar title and a really sexy email subject line to say, you can buy an accounting firm with no money down. And maybe it's possible, right? Like, I'm sure people have done it, but you have to be realistic from the standpoint of, if you were in the seller's position, would you let your baby go, your firm, the thing you put blood, sweat, and tears into to build up for no money down. I'm not saying 100% cash down. There's a happy middle ground here, but it's just as ridiculous for the seller to ask for 100% cash as it is for the buyer to ask for no cash. Let's be realistic when it comes to having these conversations. Just don't waste anybody's time, right? Like if you were in their position, you would not accept that. So let's not start from that point because it's a silly place to start from, even from a negotiating tactics perspective. Number 5, this is the most important point. And this is backed up by, I can't even tell you how many conversations I've had on the topic of a practice acquisition that went south. And they would have not purchased that practice had they done significantly more research. So point number 5 is an old expression known as buyer beware. Buyer beware. Once that is your asset, it is your problem. In other words, anything that you did not take the time to understand, dig deeper into, try and get your hands around is your problem now. So please, whatever the amount of research you think is acceptable for an acquisition, I'm not joking, 10x the amount of research and the questions you ask. Don't be afraid to move slower. It goes back to what I said in the beginning with the State of the Union. There are more firms available. More are going to become available with each passing tax season. Less people are coming into the profession. You do not need to feel rushed like this is 2005 because it's not. You can take your time. And I'd much rather go slower and ultimately feel more secure in the investment than go faster and then all of a sudden have it blow up in our face because we realized that, I'll get to a point later, we realized that something was not showing up on the balance sheet that really needed to, and I'll talk about that in a second. Number 6, if you paid attention to the email that I read, the lending process can take a little while. Average person getting rejected by 4 or 5 banks? Okay. That means we need to start the lending process earlier. So again, point 6 here is understand the time frame and how the lending process has to play into that time frame. And this comes into point 7, which is also related to timing. There's really only, I call this between the 15ths, right? Like there's only a certain time period in which it is a really smart move to make an acquisition. If you are outside of the 15ths, right? If you are after, I'll say September or October 15th, you can pick depending on your risk tolerance, right? Like if you are outside of that, it's very difficult to be able to successfully make that acquisition because we're in Q4 essentially, and we're on the back of tax season already. Very difficult. Now, if you're after April 15th and you're before September, October 15th, again, depending on your risk tolerance, you're in that green zone. That is where the most deals are going to get made. That's where the most acquisitions are going to get passed the most successfully. Again, do not feel pressured to take a deal that's outside of the 15th because you're running a high risk of just not having a really good transition because you need time to make the transition happen the right way. And then if you stack a massive amount of additional work on top of it, whew, I don't know about you, but no thank you, right? No thank you. Number 8, and this is what I alluded to earlier about when you're doing your research. If you are transitioning out of being a full-time employee, maybe you've got that high-level CFO gig, or you've just been a really well-compensated team member. Now you're saying, I'm going to go on my own, but I want to replace that income very quickly. I use that as a preface for number 8 because that's really the only time that you would not be as concerned with this particular item, which is the owner's time invested to grease the wheels, to do the work. It doesn't show up on the balance sheet, right? Like, and it's very easy for the owner to underestimate the time required to make the business run the way it needs to, right? It's really hard to validate that. So be extremely careful about that, because again, point number 8 is owner's time is not showing up on the balance sheet. If you're already running a successful firm and you're looking at an acquisition, the number one thing that you have to be factoring in is, am I buying another job, or am I buying a book of business that comes along with staff that's trained, and ultimately I have the time and capacity to manage this additional staff, not the additional workflow, right? Like there's a big difference between those two things. And you've got to be very clear with what you're looking for. If you're okay taking over that solopreneur's book of business and you want to take on all the work, that's great. Just be advised that you don't want the inverse of that to be a surprise to you. And it's like, this guy said he was working 20 hours a week, and there's easily 80 hours of owner work associated with this. Very bad. Happens more often than you can believe. Number 9. Okay, I'm running out of fingers here. Number 9. You can't overestimate the value of well-trained staff members. We know that there's a talent war going on right now. We know that it's tough to hire. It's tough to get qualified people. You see the people coming out of college with accounting degrees, and you're like, what classes? What classes did you take? How can you not do the basics? Point is that this is probably the second most valuable part of an acquisition that is not actually valued appropriately. Think about that again, right? Like people take it for granted that they have staff, and it doesn't always reflect in the purchase price, which is usually, again, 1 to 1.5x. That's typically what you're going to see in the space. 0.8 if it's a tax firm, heavy on the owner. 1.5 if it's really well-trained clients, good training team in place. You can see it maybe as high as 2x if you've got a couple of extra bells and whistles that I'll talk about in a little bit. But that's generally speaking kind of the top end of the sphere right now. When you look at financial planning, it's like 8x, which is crazy. But anyhow. However, there is one caveat on staff, and I was speaking to a prospective client, not a current client, but he had grown exclusively through mergers and acquisitions. He's doing north of 2 million, and he bought a really large book of business, just south of $1 million. And I said, "Oh, that's pretty aggressive." I said, "How'd it go? Tell me about it." And I said, "It must have come with some staff." And he said, "Yeah, but they were not a culture fit. And so we had to let them all go." And I was like, whoa, right? Like that's a big price tag. And there was a lot of attrition from that as well, because the team is used to working with the clients, right? So very, very careful about that. And on the back of this, one other point that I like to make about staff and team, as you get past the $250,000 mark, right? Like it's natural that you're going to have delegation leverage, forward-facing team members interacting with clients. Make sure that they have signed non-solicitation agreements, right? I trust my team implicitly, as I hope you all do, but trust but verify. And quite frankly, we work too hard to acquire our clients to ultimately just let them walk out the door with the person that we decided to trust their accounts with. So not the same thing as non-compete. Don't use those. Don't even reference them. It's silly. It'll kill your talent hunt immediately, and they're not enforceable anyway. Non-solicitation at least gives people a reason to think twice about those decisions. And if you're going to, again, part of the research, you get a team, are non-solicitation agreements signed and in place? That's part of the research phase. You need that. That's not optional, right? It's like, well, you got to have that in place before we take this on. Because again, if it's not a culture fit, which is hard to understand before you sign on the dotted line for the acquisition, like how do you know? Can. Well, you could maybe find a way to test it, but it's very hard to figure out if they're a good fit or not. And then afterwards, it's like, if they go and it's not a fit, you better hope that you're able to retain the vast majority of that. And we're going to talk about retention in a second here. Point number 10, and we only got one more after this. So this is, again, I find that of the firm acquisitions that go really well and the firm acquisitions that don't go so well, this is the primary sticking point of the difference. The owner, the previous owner, has to be invested in the successful transition of this book of business to a new owner. It cannot be, here's my money, I'm going to check out, or here's my money. I'll do 10 hours of consulting kind of when I feel like it. It cannot be ambiguous. How the transition happens cannot be ambiguous. When are we going to do the one-on-one meetings with the client with you? How many hours are they going to work? How long are they going to work for? And what is the client attrition clause going to be, right? Like, it's got to impact their pocketbook or their wallet in order for them to stay invested long enough for the successful transition, okay? So you can see buyer retention clauses that sometimes are going to range. They normally won't go higher than 20%, because if it's more than 20%, normally it's because the new owner is doing some crazy stuff and they shouldn't be held responsible for beyond that. But 20% is fair, right? It's enough that it makes it noticeable on the back end of the note, should this ultimately not transition as well as it ought to. But you should factor in there's going to be a natural 10% attrition no matter what. So it has to be above 10% is my point. Okay, so keep it above 10. It's hard to push it above 20, but from a buyer's perspective, if you can get it a little higher than that, you incentivize the owner to stay and help that transition to go in your favor. That's a huge win. You don't want to just like not emphasize that. Again, it has to be in place. And this is the final point. So this is number 11, and I'm going to leave you with this one. But this is, again, part of that research point that I made earlier. But it's also similar to the staff, which is I find that this is criminally undervalued. And it's not really a known, it's not something that people will even ask about during the discovery process for one of these acquisitions. Like it doesn't even like come to top of mind, but I want it to be top of mind for you, because it could be a hidden gold mine, or it could suggest that attrition is going to be a lot more dangerous than you originally thought. And here's what I mean by that. You have to understand what their current lead flow is. How many new opportunities is this firm getting on a monthly basis? I mean, if we're talking double digits and above, you're in a really good spot, right? We're talking that someone has a meaningful lead generation arm to their firm. And that is something that adds great value, because if you're the seller now, right? Like if you're the seller, you've got a little bit more leverage there, because you can say, hey, even with the 10% attrition, we got 10 plus qualified people coming in every month. So I'm not too worried about that. Now, you as the buyer, you're not as worried either anymore. You go, hey, wait, we got 10 qualified people coming in per month? Huh. So even if we only close 20% of them, that's 2 new clients a month, and there's 200 clients in here, 10%. We lose 20 clients. That means we'll replace them over the course of a year. Huh. That is tremendous value. I can't even begin to, I can't even like properly form a thought around, partially because I'm sick. But the value of that is ridiculous, and it is criminally undervalued during the acquisition process. So from the buyer perspective, you see that, you dig into it, you understand it, you validate it. Again, not just, oh yeah, I work 20 hours a week. Oh yeah, we get 20 leads a month or 20 leads a week. It's like, sure, let me make sure that's real. It's real. Ooh, and you're at 1x, even if you're at 1.5x for your multiple. I mean, this is when you want to move a little quicker. Just to be clear, like that's when things get really exciting. So anyhow, look, the point is buying an accounting firm can be an intense process, but I don't want that to be more intense than it has to be. With the market forces currently at play, you can choose to move a little bit slower. You can choose to do more due diligence. You can choose to look at multiple suitors in multiple different firms and contact multiple brokers and be on multiple lists and really have a couple of spinning plates. Like I got a client on the line right now, and I think he's looking at 5 firms right now, all in his local market, right? Like he's got 5 various different degrees, and he's being very smart about how he's approaching these. And that's all I ask of you as well, is don't feel rushed. Take your time, make a smart decision for the future of your firm. And hopefully you also do a little bit of digging into the client base and making sure that they are in fact dream clients. And so if you are looking for help with your dream client acquisition systems and you would like to work with us, there will be links floating around here where we share information like this on the regular and a whole lot more, and build these systems so that you can have that multiple and that benefit working to your advantage when it comes time to sell. My name is Tyler S. Clark. Thank you so much for your most precious resource, your time. And remember that only you can create your dream firm, but we help you every single step of the way. Have a fantastic rest of your work week and go slowly through those acquisitions. It will ultimately be to your benefit as a buyer. Have a great rest of your day.